Welcome back to John Orfer's Note. Greece is back in the news this morning. The IMF and the European Union have been quarrelling over its debt levels and how fast they can be reduced and who's going to pick up the bill at the end of the day. The question is this going to send fresh jitters through the financial markets about the stability of the Eurozone? With me to discuss this is Lawrence Mutkin, Head of Interest Rate Strategy at Morgan Stanley. Lawrence, if we take a look at our first chart, we can see what's been happening in the case of two countries in the Eurozone, Spain and Germany. If we look, perhaps you might just explain what we're seeing at the moment then in these bond markets.
Yeah, sure. I mean, I think what you've got here is a bit of a difference from what we saw back in summer when Eurozone stresses were really very high. And although it's certainly true that there's a lot of uncertainty about what's going on in Greece at the moment, the situation is different, as you can see from this. So in summer, the Spain yields were much, much higher than they were today. And as a result, you saw German yields falling considerably as a sort of flight to quality ensued.
Yeah.
This time around, German yields are back at lowish levels. And indeed, two-year yields, as you can see on this chart of yours, are in negative territory. But the Spanish yields haven't risen anything like the same way.
The big difference, of course, is the European Central Bank, Mario Draghi as president, came in at the end of July and said they would do whatever it takes to save the Eurozone. But if we look, the Spanish yields are going back up again. Is that jitters returning?
They are creeping higher, and I think, yes, there is, initially, I think the market thought that with Draghi having created this backstop mechanism, the Spanish government would make early use of it. And I think a lot of the rally was in anticipation of that early use. And obviously we haven't seen that. And now, as you say, there's doubts as to whether we'll see that in Spain at all. But we still haven't got anything like back to the levels we were at before.
Markets are getting more nervous about Spain, in other words, at least.
They're getting a little bit more nervous, but again, nothing like the level of nervousness we saw in the second quarter.
And if we look at Germany, you pointed out they've gone negative again. Does this mean that investors are thinking the Eurozone is going to break up, so they need to get into really safe assets again?
Well, I think, funnily enough, this time I don't think that's the right interpretation. I think that was the right interpretation in summer. I think this is more to do with the economic climate in the euro area, which is certainly the
growth climate.
Yeah, the growth climate has definitely worsened over the course of the coming quarter. So this reflects interest rate expectations as much as anything else, the possibility that the ECB will engineer negative interest rates at the very front end.
Okay, let's look at this, what this means for the stability of the Eurozone overall. If we take our second chart, now this is your own index of Eurozone sovereign risk. Can you just explain what this chart shows?
Yes, this index, what it does, it uses a statistical technique to try and extract from European sovereign bond prices what is systemic risk as against idiosyncratic risk. And this shows what we think is the systemic risk in the Eurozone. Okay,
so what we're seeing at the moment, we see the same thing. We see a very sharp fall in the summer, but picking up again.
Picking up again, and you can see we're sort of poised halfway between the highest levels of systemic risk, which we saw this summer and at the end of 2011, and the lows that we got around the 3-year LTRO, which is that sort of February point.
So the really big question is, are markets now starting to price in again a Eurozone breakup? Do they still believe in Mario Draghi?
I think the message that from this chart is if markets were again trying to price in a Eurozone breakup, there would be a lot further worse to go. But if we were going to get as confident as we were when the 3-year LTROs were announced, there's still considerable room for improvement.
And what's your bet about what's going to happen? Is that line going to go up again? Are we going to get more worries returning, or is it going to be controllable?
I think the fact that the OMT structure exists means that there's a backstop that wasn't there before.
The OMT is the ECB action, potential ECB action.
Exactly so, and I think that means that the chances of an improvement in this are higher than the chances of renewed deterioration.
Thank you very much. So we see there tensions rising, but the question is, are they going to get much higher? Mr. Mutkin doesn't think they're going to go out of control again, but let's see.